Hello, everybody. My name's True Demon, and I'm the Devil's Stockbroker. I bring to you today one of the most dire warnings of our time. 2023 stock market crash is on us, and it will become the worst super bubble crash since 1929. This is a crisis that is going to affect every single person on the planet, no matter their status, wealth, or nationality. Just like in 1929, the stock market crash of 2023 will bring about devastating consequences for the world. It'll be marked by plummeting housing prices, skyrocketing unemployment, and inflation soaring out of control. The wealthy elite who once thought themselves invincible will inevitably see their portfolios wiped out, leaving them in a state of panic. But the impact will not only be felt by the wealthy, it will also hit the impoverished masses with even greater force, leading to a rise in poverty, desperation, and inevitably social unrest. We'll see the return of soup kitchens as people struggle to put food on the table, riots breaking out in the streets as the masses demand their share of the pie. Governments will crumble as they're unable to cope with the sheer scale of the crisis, and the world may descend into chaos and anarchy. However, there is hope. For a few of us that take action now, this disaster can be avoided. The first step is to increase your own personal knowledge of finance. This is where Hell's Trading Floor comes in. The following clip comes from a meeting between myself and the largest supporters of Hell's Trading Floor, the Demons, who have tirelessly worked to increase their own knowledge and financial well being, and sharing this greater understanding with the friends they made in our thriving community. Here, we will unpack the gravity, scale, and the consequences of the pending crisis in an attempt to avoid the worst of its outcome. If you also want to better understand the markets and seek to protect yourself from this coming financial catastrophe, please consider joining us at Hell's Trading Floor, where we provide knowledge, tools, and timely data to enhance your own trading strategies and achieve your highest financial potential. Thank you so much for joining us, and have a hell of a time in the markets. All right, so let's go ahead and open up with where the market is currently at. We've had quite a rally this past month. So since the bottom of December, we got quite a push, almost just about 8% from the low point in December. And everybody's trying to figure out where the top is. So this week's going to be a little bit interesting. It's kind of I'm expecting it to be a little bit indecisive for the first half, maybe slightly bullish. What I'm thinking for the S&P right now, the news has been kind of letting up a little bit, and there's this talk of like maybe the recession fears aren't as bad as we think and stuff like that. There's all these articles publishing from the mainstream media that things aren't as bad as they seem. And well, for one, I think they're extremely wrong, but it's a narrative and it's what they do. So I've been carefully analyzing the support resistance levels, and we have this ceiling up over our heads right here. That if we did manage to break it, would be that would give us the potential to get up to maybe 410 or 412 at the highest. This is where we ran into resistance after the first bounce in early September, and we hit our head off of 412 in mid September. So, depending on how we open on Monday, we might see a little bit of a pop and possibly break through to this range before we start to see declines and retracements back down to these support levels. And then after spending a day or two in this area, continue dropping and dropping. My thinking is that we're about to see the failure of this megaphone very soon. This is not to scale, because obviously this chart setup is kind of putting us all the way out to late March, which is a little bit far beyond my timeline for this retracement to occur. My my thoughts are is that we'll probably see the decision made by the end of this week as to where the market wants to go before we see a big drop and we return to test the top of this megaphone. And then what's going to determine if we continue the bear market or not is if we end up breaking into this megaphone and then start another panic. Because my fears here, based on how the housing market has reacted to recent news, um, versus what the data is actually showing, tells me that the narrative is winning over hearts and minds and the uh, pushing the real estate sector into bullish momentum that's unjustified. And I think we're about to get smacked pretty hard. This is the other major component of the market that I don't think that everybody is giving the respect it deserves, which is that XLRE has just hit its head on its 200 simple daily moving average. So I called this out on my video that I did just a few days ago after the Friday close. And I'm curious what everybody else's thoughts are and how y'all think the other sectors are going to react to this if whether my thesis proves right or wrong.
I just got to say, I think that once, like, if we actually capitulate a little bit here, people are going to think that. I think that that's going to cause the panic, and it's probably we're going to see a real leg down. And I see that you're looking at going back down to that support. I agree with that, but I'm also hesitant. I feel like that's going to really confirm a lot of bearishness to a lot of people, and we could probably go further than that.
Oh yeah, that's kind of my whole fear is that the capitulation that I have marked is actually way down here at 260. That was my target before we would ever actually see the recovery.
I mean, not like this is the perfect metric in the world, but if you take the moving average of the entire data set, that's kind of where it is,
Yeah, part of what I
right down there.
part of part of what I had used to figure out what these levels looked like was basing it off of the bottom of the 2008 crash and drawing a line of support for all the flash crashes that occurred between 2008 till now. And we've had a few bear markets. We've had one in 2011. We had another short one that took place in late 2015, early 2016. We had the flash crash from the panic when they turned off the repurchase facility in late 2018.
Mhm.
And then, of course, we had the COVID crash. And if you draw supports along an average of those lines, then that would actually set you up pretty nicely for a strong leg of support right around 280. But with every crash that we've always had, if you look at these on logarithmic scales, for most of the crashes that we've experienced, not just on the SPY, but like the on the Dow Jones index and some of the other indexes that have been around since like the 1920s and even further back than that, there's this pattern of crashes that return to this linear support. I think that one
Yeah.
exception would probably be the .com bust because of how overvalued the tech sector drove the value of everything else. And the thing is that the .com crash only crashed the tech sector. It didn't crash the staples or the industrials, which was a big heavyweight for the market. So only the tech sector got smashed. So this crash wasn't as bad on the SPY as much as it was on, like, say, the NASDAQ.
Can I show you another way of looking at the SPY?
Yeah, sure.
Go SPY divided by
Mm-hmm.
money supply 2. Yeah, there you go. That's the one.
USM2. Okay.
This is inflation adjusted.
Okay, interesting.
Yeah, we've never reached the might of the .com of 2000, and you
That's
can see clearly that we're up against resistance of the 2008 high.
oh wow. Yeah. Yeah, you're right.
Interesting.
That's
No,
very
that's really
interesting.
cool.
We had hit that height right before the COVID crash and the height of 2021 also. That's
Yeah.
very interesting. I wonder how this compares if we look at the S&P, because the S&P will take us even further. Yeah, the .com crash dwarfs everything. This takes us as far back as the 1960s. There's the flash crash of 87.
Yeah, that's definitely a chart you want to take a look at because it's really eye opening when you adjust it for inflation.
Hmm.
That is cool, people. That's really good
Yeah, that is very interesting, actually.
find.
The .com bubble is quite a it's quite an anomaly. But looking at SPX versus the money supply here, I noticed the money supply grew so substantially that even though this is the biggest super bubble that we've experienced, even bigger than and it's an entire market, like it's broad market bubble. It's not just tech like .com was. Like you consider how this bubble, because what this chart is telling us is that the value of equity was exploding versus the money supply. But this one, I mean, 2008 was the same level of growth as the .com era with a very small growth in money supply. And then from that point forward when like equity completely tanked after 2008 and we've had this slow growth, the money supply has been getting pushed up consistently with the growth of equity ever since that point. And consistently, I'm seeing the same resistances getting tested, the same support resistance here and here, getting tested here and here and here. So, this is a significant level, and this marks the bottom of multiple crashes that we've experienced. But, like the COVID crash in particular, marks this floor. And then we have these slightly weaker resistances. This was significant at the beginning of the .com recovery. It was the last support before the big capitulation in 2008, and it was a significant level throughout 2014, 2016.
Boy, isn't that just fascinating, eh?
Yeah, it really is. I think this does mark out something significant. I'm willing to bet that if we see these different levels get broken, yeah, I'm willing to see if we see these levels get broken, then it's a signal that we're going to test the next one. There's something here. It's like trying to figure out a puzzle. I think I might have a pattern figured out here. So, with the great financial crisis, before it had a capitulation, there was this breakdown, a quick recovery, and then another breakdown, and then a massive recovery before it broke down again, bounced, and then capitulated. If we look at our market, we had just a little bit higher than that same level. But the first time that we had truly broken through this was right here, back in June. Now, the June drop was really bad. Then we had our summer rally. We dropped again in the fall. And then we had this big recovery that brought us all the way back up to the 200 moving average. So the next move, if it followed the same pattern as the GFC, would be all the way down like so, a small bounce, and then capitulation. And that could take all of next year, but I think it might start I think it could be starting this spring, which would line up with my thesis from the beginning, was that we're going to see a big crash starting in spring, and it's gonna signal the rest of the market capitulation to follow.
I wholeheartedly agree.
So if that's the case, we get a drop all the way down to here, bounce and try to retest the megaphone, and then capitulate. And that's doable within the span of the timeline that I had set. A drop back down to 350 would be honestly terrifying, and that would certainly start up some panic. So then the first sign of things going wrong is if it re-enters into this megaphone. And that's a very simple signal to watch for. If it breaks back into this megaphone and then can't get out of it, then it's coming back all the way down to retest this support. So all you have to do is just watch for that return back to the megaphone and then use that as your signal for going short for the long term.
You know, the saddest part about all of this is people are going to assume a double bottom, and they're going to get burned really hard.
Yeah, we still haven't gotten the big capitulation for the entire bear market yet. We've only seen a 25% drop in equity. We still have 25 more percent to go because
Yeah.
every bear market has seen an average of 50% drops in equity. And this is one of the biggest ones that we've experienced so far. And we've only just got started. This has been a very short bear market so far.
What I
Very,
find interesting too is the CEO of Chase is basically saying, "Hey, take your profits and get out,"
yeah.
and he's saying it.
Yeah, I mean that's a great metric to go by, Steve. But again, it really goes back to like fundamentals that nothing's changed in our situation. We haven't gotten, rid of inflation. We haven't started, you haven't seen manufacturing improve. You haven't seen any fundamentals change. So consumers are not healthy yet. Their spending's still dropping. That 50% is true. It's a great historical metric and definitely an indicator that we're not good. I look at the fundamentals and they're still really horrible. But
Yeah,
to me,
pretty,
if you suddenly saw that manufacturing started improving and we saw things improving, then you'd be doubtful, looking at a historical metric. You know what I'm saying? Like if you started seeing the economy turn around, then the metric, you'd be questioning whether that would be a valid metric, the historical drops. But the fundamentals suck.
yeah, they do.
Something interesting about money supply is money supply goes up, the cost of SPX goes up because the value of the money goes down. So what it can do is it can create an artificial rally. And if you look at the COVID rally, while it is sharp, yeah, COVID rally. Also, you contrast that to the amount of money you guys printed,
Hmm.
at the same time.
Yep.
I mean, it's a nasty storm.
Yeah, it is. It absolutely is. And the thing is that we all should have seen it coming. I didn't figure this out until I started really paying attention to the stock market after the COVID crash. I pulled out most of my money out of the market right as we were collapsing at the end of February, and I'm so glad I did. I emptied out my Acorns account, I emptied out my equity accounts, and I rode out this wave, and then I re-entered somewhere in April or so, and I wrote it out and did very well. There are some businesses I wish I had invested more in, like Avis Budget. I almost entered in at the bottom when they were trading at $19 or so, and I will regret not doing it forever. I could have entered. Yeah, I thought about entering right here. I almost entered it when it was $19, and I decided against it for some reason. If I had just put all my money in car, then yeah, I think I would have been pretty set for life. But oh well, what are you gonna do?
My
Anyway,
goodness.
yeah,
Yeah,
whatever, coulda, woulda, shoulda. We just have to live with our choices, I guess. But anyway, back to the point that Peaceful Lizard was getting at is that right here at the bottom of the COVID crash, the thing that brought us out of this was not, it had nothing to do with the fact that people were like, oh, this is the bottom and things are going to be great. No, it was the Fed stepped in and said, we're going to print enough money until this problem goes away. We're going to buy our way out of this entire crash and we're just going to give the money out to every bank everywhere. And they just crashed the interest rates, gave out all of this free money, handed thousands of dollars from the Treasury, handed thousands of dollars to individual homes, and then everybody was flush with cash out of nowhere. And then, if you're like me in a position where it's like, well, the stock market's down really, really bad, and I'm not financially hurting, but I'm getting this free cash anyway from the government, I might as well put it in the stock market. So that's what literally everybody was thinking that had cash to burn. So it's like, I'll just put it in the stock market, and there it goes. Just there's the rocket taking off into the stratosphere. And that's exactly what happened. The surge in the money supply triggered this whole thing. So yeah, that's a perfect example. And you can see that, despite looking at how, you just saw what that chart looked like. As a matter of fact, let me put the actual SPY in the background. This is the SPY versus the money supply, and this is the SPY just by itself. Look at the difference. Look at how much money we must have poured into the market in order for this equity growth to occur. But when you look at the ratio chart, it's barely moved. And it's these are still the peaks from the 2008 bubble. I'll tell you what, the SPX USM2 chart, while a pattern may exist that could be a predictor of the next leg of the crash, I think more than anything, this is a great way to time tops and bottoms of the market. That's what I think. Because if
Absolutely,
you look
thank
at
you.
if you look at these, like the quantitative tightening switch right here perfectly matches up with the peak that we had in the COVID, the pre-pandemic. And this is exactly where we switched over to quantitative tightening mode, or rather they announced tapering and then switched to quantitative tightening. And that was enough to scare the bejesus out of everybody. And the panic started almost immediately. Yeah, it was a
I
little
don't know
bit.
why people don't talk about this chart.
I don't know either. This is my first time ever seeing it, but it's a beautiful chart. It actually does tell me quite a lot. It says it gives a lot of information in not so many words. It's very good.
I actually figured out how to do this when I was watching another trader on TradingView. He, just as a joke, kind of, he was complaining about how people were complaining about the price of coffee, but then he adjusted it to inflation and it was at a historic low. So I thought to myself, well, geez, wouldn't this be the perfect method to measure the SPY?
Yeah, yeah. That actually makes that actually makes really good sense. So now the real question is, where's the floor for everything, and are we going to see a COVID low, or is it going to be just as bad as it was in 2008? I think if at any point we get down to where equity has dropped so far in value as the money supply grows, um, or if they resume quantitative easing, which I don't think is on the table for at least another year. But assuming that we did have a massive drop in equity that coincided with an increase in the money supply, this could be a worst case scenario in our future. It would be drastic. It would be very extreme. I think that this one is the more likely scenario for a bottom, but
Mhm.
you never know. It could go
I want to
down.
say one caveat to this chart
Yeah.
is there's no way to predict the actual size of the move. You might be able to predict, but you'd have to be keeping your eye on this chart, right?
Hmm.
Because it just
Certainly.
doesn't scale.
Yeah, certainly. Well, the one thing that I do see here that does seem rather consistent is that the worst drops always come after a rejection from the 200 period EMA. And I see one right here in May of 2001, which anybody that lived through that will tell you May of 2001 was the start of it was the beginning of the end for the dot-com crash. And then here, May 2008, that was the last peak before the big capitulation started. And the whole thing went from May until December. And it was just free fall from that point forward. There was a little blip that occurred in like August, but it was very small. Um, and now we've got something very similar. We've actually tapped on the 200 period EMA twice, according to this chart. That's yeah, yeah, we've hit it twice. Once in August, and then once it was actually this past week's candle. And this is on a weekly chart for the record. There's most certainly patterns here, but what scares the hell out of me is that this entire bubble that we've been experiencing is the definition of a super bubble. It's an everything bubble. It's worthy of its name. I don't think that we have any other time in the stock market to compare it to, except for possibly the 1927 stock market crash. Leading into the Great Depression. It's that severe. I don't think that we'll have another bubble quite like this.
I've never adjusted the Dow to inflation.
That'll be very difficult to do since the money supply data only goes as far back as the 60s. But
You're right. Okay, that's probably why.
yeah, but that would take you pretty far back. Let's see. If I adjust this for 2 weeks, each candle becomes 2 weeks. This is the worst crash that we saw. It was a 90% loss of equity in the stock market back in 1920, from 1929 till 1932. It was a bad time for us to see that size of a move. And I don't think that we would, but for that size of a move to occur, for even an 80% drop in equity, we'll just keep it at an 80% drop in equity. That would take us back to the bottom in 2009. That's how far we would have to fall. We're talking seeing the Dow Jones go from $34,000 all the way back down to sub 7,000. That we haven't seen it more than in more than a decade and a half. It would be disastrous, to say the least. So it's a lot of speculation that we're doing here, but the point of it is to just kind of give you a sense of scale for just how small our crash currently is versus what, 2008 or even the dot-com crash, and certainly small compared to the crash that led to the Great Depression. That we haven't seen anything like that in over 100 years, and we're due. Well,
I mean,
not
speaking of
almost
Chase
100 years.
and derivatives, wasn't the depression crash related to margin?
It was related to margin. It was related to a lot of things, actually. There was also a housing market crash that occurred during that time. Not a lot of people are aware of that.
Right, I didn't know that.
Yeah, a real estate crash occurred just at that time. And another thing that occurred at the same time was labor unions had not yet organized. And one of the
Oh,
problems was that business owners, this is post-industrial revolution America, right? So all of the factory workers were pushing for cheap product, but they were raising prices on everybody. And businesses were doing phenomenally well, but working class citizens were basically working with slave labor. They weren't able to. They weren't really able to make ends meet when the crash started to happen, and businesses started to go under because the cost of their materials were going up as people were falling out of a job. The businesses that supplied the raw materials failed to keep up with demand, and things just kind of fell apart. You know, we're experiencing something very, very similar where our tech sector is being destroyed right now because of a lack of access to semiconductor material. And the cost of semiconductors and lithium for batteries manufacturing is creating an inflated cost to those assets. So all of the companies that depend on that, which it's everything, it's literally everything. In the case of the 1920s, everything that everybody needed was related to steel. Steel supply became extremely expensive very quickly, and that destroyed everything. Oil became very expensive. That destroyed access to everything. All of these things happening at the same time echo what's currently going on now. And this is on top of a real, like, it's too perfect. You can't make this up. Between oil prices becoming extremely hyperinflated, you're seeing a loss of access to semiconductors, which is the raw material that drives our entire world right now, and nobody pays attention to that, on top of a massive real estate crash that is already in progress, and we're about to face a huge foreclosure crisis. None of those, that it's like the dot-com, the 2008 crash, and the 1970s crashes combined, and we haven't even seen a 50% loss of equity. We've barely seen 25%. This could be depression scale crash. This could be a 1929 scale crash,
For sure.
just based on all of these things happening together. If it weren't for all of these things happening all at the same time, I wouldn't believe it possible, but it is. We've got oil, semiconductors, real estate, massive inflation, all at the same time. Just a really quick recap. Keep in mind the overall market is looking extremely poor. As we were looking at the money market and SPX, it looks like we may be experiencing one last leg of resistance. And considering that we've seen tops in Apple, Amazon, JP Morgan, Meta, Netflix, Nvidia, and Tesla all at the same time, they're all showing topping formations. Any one or all of these stocks could be a great opportunity for to enter a short position. For me personally, I'm thinking that the biggest shorts are probably going to be Apple, Netflix, and Nvidia. But that's going to be it. Thanks, guys, for attending, and I will see you all next week. Until then, have a hell of a time in the market. Thank you guys so much for tuning in to watch this video. If you enjoyed the content and you found this information helpful to you in your own trading strategies, be sure to leave a like on the video. It helps out the YouTube algorithm and helps us reach out to others who need this information too. Be sure to subscribe if you want to see more. And if you're not a member of Hell's Trading Floor already, consider joining our Discord by joining us at hellstradingfloor.com, which will allow you to sign up for our Discord at discord.gg/hellstradingfloor. Thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.